Let's dive into a fundamental yet powerful financial ratio, the price-to-book, or PB, ratio. If you're looking to understand how the market values a company relative to its assets, this is a key metric to know. It's surprisingly straightforward and we'll break it down step by step. So, what is the price-to-book ratio? Simply put, it compares a company's market capitalization, that's the total value of all its outstanding shares, to its book value. Book value is essentially the net asset value of the company. Think of it as what would be left over for shareholders if the company liquidated all its assets and paid off all its liabilities. To calculate it, you take the company's current market price per share and divide it by the book value per share. And how do we find book value per share? That's total shareholders' equity, which you can find on the company's balance sheet, divided by the number of outstanding shares. Let's illustrate with a simple example. Imagine a company, let's call it TechGadget Inc. TechGadget has 10 million shares outstanding, and its total shareholders' equity is $50 million. That means the book value per share is $5, $50 million divided by 10 million shares. Now, let's say TechGadget's stock is currently trading at $25 per share. To calculate the PB ratio, we divide $25 by $5, which gives us a PB ratio of 5. What does that 5 mean? It means the market is valuing TechGadget at 5 times its book value. Generally, a PB ratio of less than 1 might suggest the stock is undervalued, meaning it's trading below what its assets are worth. A PB ratio greater than 1 suggests the market believes the company is worth more than its book value, potentially due to things like brand reputation, growth prospects, or intangible assets. Now, why is the PB ratio relevant, particularly for investors in the U.S. market? Well, it's a useful tool for several reasons. First, it helps you identify potentially undervalued companies. If a company has a low PB ratio compared to its peers, it might be a bargain. However, remember, low isn't always good. It could also signal that the market has concerns about the company's future prospects. Second, the PB ratio is particularly helpful when evaluating companies with significant assets, like banks and manufacturing companies. These businesses often have a large portion of their value tied up in tangible assets, making the book value a more relevant metric. For example, comparing the PB ratios of different banks can give you a sense of which ones might be undervalued relative to their assets. Third, it can help you assess the risk of a potential investment. Companies with high PB ratios might be considered more speculative, as their market value is heavily reliant on future growth expectations. If those expectations aren't met, the stock price could fall significantly. Let's look at another example, but this time with a slightly different scenario. Consider RetailGiant Corp. They have 20 million shares outstanding and $100 million in shareholders' equity, resulting in a book value per share of $5. However, their stock is trading at $8 per share. This gives them a PB ratio of 1.6. While higher than our first example, it still suggests that the market isn't overly enthusiastic about the company's prospects, or that it's reasonably priced. Now, it's important to remember that the PB ratio isn't a perfect metric. It doesn't take into account intangible assets like brand reputation, patents, or intellectual property, which can be significant value drivers for some companies. Also, accounting practices can vary, making it difficult to compare PB ratios across different industries or countries. Historical cost is used to calculate book value, meaning assets are listed at what they were purchased for, and not their current market value, which can distort the ratio. Furthermore, a low PB ratio can sometimes be misleading. A company might have a low ratio because it's in a declining industry, has poor management, or is facing significant financial challenges. Always dig deeper and consider other financial ratios and qualitative factors before making an investment decision. To get the most out of the PB ratio, Compare it to the P/B ratios of other companies in the same industry. Also, look at the company's historical P/B ratio to see how it has changed over time. A consistently low P/B ratio might indicate that the company is undervalued, while a consistently high ratio might suggest that the stock is overvalued. In summary, the price-to-book ratio is a valuable tool for assessing a company's valuation relative to its assets. It's calculated by dividing the market price per share by the book value per share. A low P/B ratio might suggest undervaluation, while a high ratio might indicate overvaluation, but always consider other factors and industry benchmarks before making any investment decisions. It's a useful starting point for your research, but should never be used in isolation. Remember to analyze the company's fundamentals, industry trends, and overall market conditions before investing. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.